Hello everyone, this is Kshitij Agrawal. This is part 2 of direct tax amendments brought in by Budget 2025. In first part, we have covered few topics like individual tax rates, exemptions available to IFSCs, exemptions available to non-residents in case of few kinds of derivative contracts, some exemptions related to sovereign wealth fund and pension fund investments, trust exemptions, and electronic manufacturing system exemptions available to non-residents, and also we have covered tonnage taxation to inland vessels. Now we'll start with part 2, and the first topic in part 2 is taxation of business trusts. What is covered over here? Business trusts. There are three kind of business trusts are there. Real estate investment trust and infrastructure investment trusts are there. Dividend income, interest income, and rental income are the major incomes what these kind of trusts are earning. These trust income, whatever they are earning, is taxable in the hands of the unit holders until and unless it is specifically exempted by any of the sections. And whatever tax is applicable to these trusts are taxable at the rate of maximum marginal rate to these trusts, but subject to the provisions of section 111A and section 112. In respect of 112A, there was no reference earlier in this section that 112A should also be considered while calculating the maximum marginal rate. Like, it should not be applicable on 112A or that maximum marginal rate. But now what is done? They have included the reference to 112A because the department thought that including 111A for the same category of assets, short-term income of same category of asset was considered as a concessional rate, but earlier long-term capital gain of those kind of assets like units of equity-oriented fund, units of business trust, or listed securities, if it is in the long-term nature, it was being taxed at the maximum marginal rate. Now, in order to avoid this ambiguity, they have included 112A reference in this section. So now, if income of the trust is taxable at the maximum marginal rate, then three sections they have to consider: 112A, 112, 111A. If income is of these three natures, then it would not be taxable at the maximum marginal rate. This amendment is applicable from 1st April 2026, means assessment of 26-27 for the transactions happening between 25 to 26, because we calculate the taxes in the year of assessment, not in the year of earning the income. Now coming to the next one, business connection. In respect of the business connection, one definition is the economic presence. Business connection, actually according to section 9 subsection 1, or we can say section 9 clause 1, it says that any income which is accruing or arising in business connection in India, then it should be deemed to be accrue or arise in India. But there are two explanations which are contradictory in nature. First one is the explanation 2A, which says about it will be called as business connection if there is a significant economic presence in India. Which means, what does significant economic presence means? Significant economic presence means any transaction done by the non-residents in India for goods, any transaction done by the non-residents in India in related to goods, that is called as business connection, that is having a significant economic presence over here. We'll read it as follows: significant economic presence for this purpose shall mean transaction in respect of any goods carried out by a non-resident with any person in India. So any transaction done by non-resident in India in respect of goods. Now this is explanation 2A. Explanation 1B contradicts it, because explanation 1B provides some exemption to non-residents in respect of income accruing arising in India if it is for the purpose of exporting outside India. If a non-resident is purchasing any goods for the purpose of exporting it outside India, then it should not be considered as business connection. But after the introduction of explanation 2A, this was also coming under the definition of business connection, because it says non-resident any transaction for goods in India with any person in India. So in order to remove this difficulty for the non-residents, explanation 2A of section 9 has been amended, and it has been provided that this transaction will not be considered as business connection in India. This also will be applicable from 1st April 26, same way assessment at 26-27, because this is also not transaction specific amendment. Now coming to capital gain related exemptions and startup taxations. Four major changes are there over here. First is the unit linked insurance plan. What is the changes in the unit linked insurance plan? The unit linked insurance plan, two things are there. If the policy is taken 1st Feb 21 and 2.5 lakhs is the premium is more than 2.5 lakhs, then it is in aggregate or an individual, then it is taxable. And if it is a non-ULIP, then 5 lakh limit was checked from 1st April 23. Now what is happening in the ULIP? It is exempt under 10(10)(d). 4th, 5th, 6th, 7th. 4th provisos were added in section 10 subsection 10(d), or we can call it clause 10(d) also. So this exemption was available if ULIP is exempt under 10(10)(d). If premium is up to the certain limit, then we were having the benefit. Just now we saw in 10(10)(d) some exemptions are available. How exemptions are available, like how it will be taxed now. If exemption is not applicable for 10(10)(d), then how it will be taxed? If it is unit linked insurance plan, then it will be taxed as capital gain. And if it is a non-unit linked insurance plan, the 5 lakh premium thing, then it will be taxed on the income from other sources. Now how it will be taxed? For income from other sources, it is taxed in the same manner it was taxed earlier. For ULIP, no clarification was there, no rationalization was there how it will be taxed. So they have provided 3 rationalization: how it will be taxed, under which head, under which section, and under which definition it will be taxed. So it is therefore proposed to rationalize the provisions for unit linked insurance plans so as to provide that unit linked insurance plan which is not exempt under 10(10)(d) is a capital asset. In the definition of capital asset, ULIP will be included as per section 2 clause 14. Now profit and gain from redemption from ULIPs, whatever it is there, on which exemption is not applicable. All these 3 cases will apply where exemption is not applicable of clause 10(d) of section 10. So profit and gain, if it is anything is there, if any profit is there, it will be taxable as per capital gain. It will be capital gain. It was capital gain earlier also under section 45 subsection 1b. And if exemption is not applicable, then it will be treated as unit of equity oriented fund, or we can call it directly, it will be treated as equity oriented fund. This is given, this new point is there as per clause A of explanation to section 112A. This is the amendment, and this will apply from 1st April 26. So 3 things will happen in the ULIPs. 3 rationalization is done. No specific amendment is not there. It is a capital asset under section 2 clause 14. It will be taxed as capital gain under 45 subsection 1b, and it will be covered under the definition of equity oriented fund. This also will apply from the assessment year 26-27. Now coming to the second amendment in case of capital gains, there is some change in the definition of capital asset. What is the change in the definition of capital asset? In case of the investment funds, we see capital asset includes, we know capital assets includes every kind of property, stock in trade, and one more point it includes, that is the securities held by foreign institutional investor if they are investing according to the SEBI 1992 Act. Then it will be considered as capital asset even if it is held at stock in trade. Then also for foreign institutional investors it will be treated as capital assets. Now in respect of investment funds, same thing has been applied, that if any income is earned on any amount, any security held by investment funds are defined under section 15 UB. If that investment funds are having any securities, holding any securities, and it is sold, then it will be treated as capital asset. Whatever gain they will have, it will be treated as capital asset if such security is held as per SEBI Act 1992. Basically, the earlier provision what was applicable in case of foreign institutional investors is now applicable in case of investment funds also. This will also apply from April 2026, 1st April, and assessment year 26-27. Now coming to startups. Startups have a benefit under 80 ISC of the Act, that they will be provided a deduction of 100% from the profit, whatever profit they are earning, if they are eligible business, like eligible startup is there and they are doing eligible business, then they will get a benefit of 100% of deduction out of the first 10 years from the date of its incorporation. The company can choose, the startup can choose any of the 3 years for claiming the tax benefit under 80 ISC, and those 3 years should be consecutive. Now what is the conditions? What were the conditions? What is the startup actually? Total turnover of the business should not be more than 100 crores. For claiming these exemptions under startups, the total turnover should not be more than 100 crores. It should hold a eligible certificate of the Inter-Ministerial Board of Certification. From that board they have to receive a certificate that they are doing the eligible business, and it should be incorporated after 1st April 16 but up to 1st April 2025. So from financial year 16-17, starting of the financial year 16-17 to end of financial year 24-25, if any company is incorporated as a startup, then this exemption of 3 years out of 10 years deduction can be claimed by the startup. Now, this time period of startup eligibility criteria for startups have been increased by 5 years. So if any startup is incorporated up to 1st April 2030, before that date, means till 31st March 2030, then they can claim the same benefit now. That 3 years out of 10 years they can claim the deduction under 80 ISC. So just the time gap, just the time period to claim the exemption for starting of business is increased by 5 years. Now coming to other point, the last point in case of capital gains, there, it is in respect of non-residents. Capital gain in respect of non-residents. All the rates were changed. We know that in Finance Act 2024, various rates of capital gain tax was changed from, for long term it was changed from 10% to 12%. So under section 15 AD, 115 AD, long term capital gains, two kind of securities are there. One that is covered under 115 AB and one that is not covered under 115 AB. If any security is not covered under 115 AB and any non-resident is transferring it, then the rate of tax was earlier 10%. It was retained at 10%, but in order to bring it to with parity with other non-residents and other global businesses, it is done to 12.5. It has been increased to 12.5%. Such securities should not be a security covered under 115 AB and it should not be a security defined under 112A. If these two conditions are met with those securities under 115 AD, then the tax rates applicable on these securities is 12.5% instead of 10%. This amendment is also applicable from 1st April 2026, which means assessment of 26-27. Now coming to capital gains exemptions are done. Now coming to the TDS exemptions. TDS exemptions or TDS rationalization, whatever is being done. In TDS, some rates have been changed and some thresholds have been changed. Rates were changed in Finance Act 24, wherever 5% was applicable, 2% is applicable now, with some effective dates. We'll go one by one for TDS sections. Section 193, Interest on Securities. Currently, there was no threshold on interest on securities except for some government securities, and the tax rate was 10%. They have proposed that if any interest on security is earned, then 10,000 should be the limit now. If it is earned more than 10,000, then it should be TDS should be liable on it, otherwise TDS should not be liable on it. So they have increased the threshold limits for few sections. Coming to section 194, where individual shareholder is earning some dividend from any company. The earlier the threshold limit was 5,000 rupees. But now they have proposed to increase the threshold to 10,000 rupees and the rate of tax will be 10%. Section 194B and 194BB, winning from lottery, crossword, horse races, these cases. In these cases, the tax rate is still 30%, TDS rate is 30%. But earlier the case was, if during the year aggregate amount of payment in respect of these transactions is exceeding 10,000, then TDS was required. But now they have given some relaxation that in respect of each transaction, if amount is up to 10,000, TDS is not required. For example, suppose a person is making the payment and he's making the payment of 20,000 in the year. He's making the payment of 20,000 in a year. According to current threshold, he is required to deduct TDS on this amount. Suppose the same person is having the transactions 9,000, 9,000 and 2,000. Then in this case, he is not required to deduct TDS on this amount, because now they have done the single transaction limit exemption relaxation has been provided. Now coming to the next section, 194D, Insurance Commission. Insurance Commission, then again income by way of commission, prices on lottery tickets and commission on brokerage. D, G and H. 194D, 194G, 194H. Basically insurance and commission and brokerage related cases. These three cases, the earlier limit was 15,000. Now they have increased the threshold. They have proposed to increase the threshold to 20,000 rupees. Now here the rates have also been changed in the previous budget. For 194G, in respect of the commission in case of lottery tickets, and 194H, commission of brokerage, normal other than covered above, the effective rate was 5% if transaction is happening 30th till 30th September 2024, and if it is after that, then it is 2% TDS. Then 194D, the effective date, it is same, the rate change is same, 5% and 2%, but the effective date is 1st April 2025 for the transaction. Coming forward, section 194I, this says 2% or 10% TDS is applicable on rent, 2% in case of plant, machinery, furniture, equipment, 10% in case of land and building. Earlier, the threshold limit was during the financial year 2,40,000. If any payment is done more than this amount, no matter what monthly payment was going, if the aggregate amount during the year was more than 2,40,000, then TDS was required to be deducted. But now they have proposed, if the rent is 50,000 per month or part of the month, then only TDS is required to be deducted at 2% or 10% as the case may be. Coming to 194J. 194J, fees for professional services, 2% and 10% rates are applicable. Fees for technical services, royalty, these cases it is 2%. Cinematographic films, these cases it is 2%, others it is 10%. The threshold limit was 30,000 earlier. They have proposed to increase the threshold to 50,000. Next, 194K, income in respect of mutual funds, units of mutual funds of a specified company or undertaking. Here also TDS was 10%, and they have proposed to increase the limit threshold. Earlier TDS was not required if amount is up to 5,000. Now this amount is increased to 10,000. If any enhanced compensation is received under section 194LA, then also 10% TDS was applicable if the amount is up to 2.5 lakhs. Now it has increased to 5 lakhs. Coming to next section, 194LBC, whatever income is payable by securitization trusts. Earlier, if the pay is individual HUF, then it is 25%, and any other person it was 30%. Now this rate has been cut down significantly, and for in all the cases it is 10% itself. Now these are the changes made in the TDS. One more change is there in the TDS, that is the interest on other than interest on securities. Now coming to this will apply in case of banking companies, cooperative banks, in deposit with the post office saving accounts, any scheme notified by the central government, and other cooperative societies, and if anything is not covered in these cases and it is not interest on security. Current threshold in most of the cases like banking company, cooperative banks and post office, it was 40,000, but it has increased to 50,000. Actually the threshold was 40,000 for normal people, 50,000 for senior citizens. So both the threshold has been increased in case of banking company, cooperative bank, other cooperative societies, and post office schemes notified by the central government. In these four cases, same limits were there and same changes have been made now. 40,000 limit for non-senior citizens have been increased to 50,000, and 50,000 threshold for senior citizens has been doubled and increased to 1 lakh rupees. And in any other case, the limit was 5,000 in all the cases, whether he was a senior citizen or non-senior citizen. This limit has been doubled to 10,000 now. These are the changes brought in TDS. Now coming to the changes brought in TCS, only two changes are there. In case of timber, of not being a tendu leaves, if it is obtained under a forest lease, or if any timber obtained by any mode other than under a forest lease. So all kinds of timber were covered over here, apart from tendu leaves. If it is under a forest lease, then it should not be a tendu leaf. Timber apart from tendu leaf under forest lease. Other timbers including tendu leaves, if it is not under forest lease. The rate was 2.5% and it has reduced to 2% now. So in this case, if we consider about tendu leaves, only one case tendu leaves is still 2.5%. All other timbers are 2% now. If it is under a forest lease and if it is a tendu leaf, then it is 2.5%. Other all cases, now it is 2%. Now coming forward to TDS and TCS in case of sale of goods and purchase of goods. Currently there are two sections, section 206C subsection 1H and section 194Q. Subsection 1H of 206C says that if a person who is the seller should collect TCS for amounts exceeding 50 lakh rupees if he is selling anything to any buyer at the rate of 0.1%. Same provision applies in case of 194Q. that if any person is the buyer, then he has to deduct TDS of 0.1% if he is making any payment of exceeding 50 lakh rupees. So whatever excess amount is there, on that TDS is required. So this provision was creating confusion and ambiguity between the sellers and buyers. In order to avoid this ambiguity, section 206C1H, which is the TCS compliance in respect of the seller, has been removed, and only TDS will be applicable in case of such transactions. If any sale of goods is there, specified goods sale is there, then only buyer is required to deduct TDS at the same rates and at the same quantum, that 0.1% and amount exceeding 50 lakhs. This criteria is not changed. Other criteria have changed. That TCS has been removed. Coming to the next point, earlier the higher rate of TDS or TCS was done in every section wherever it was applicable in two cases: if the person on whose PAN TDS is deducted or on whose PAN TCS is collected, he is a non-filer or he has not furnished the details of PAN. Now non-filers of return of income have been provided a relief that if they are the non-filers of return of income, then TDS and TCS will not be deducted or collected on a higher rate. So consequently, section 206AB and section 206CCA of the Act in respect of TDS and TCS respectively has been amended, and now higher rate of TDS will apply only in case of non-furnishing of PAN and won't be applicable in case of non-filers of ITR. Coming to the next case, prosecution in respect of the delayed payment of TCS. This prosecution has been removed by the central government if the payment is done up to the due date of filing of TCS return under subsection 3 of section 206C. Prosecution was included under 276BB earlier. Now that has been removed, but it doesn't mean that the penalty or interest what is required to be paid by the defaulter is removed. Only the prosecution provision has been removed, and that too if the amount has been credited to the account of the central government up to the due date of filing of TCS return for that quarter. Coming to the changes made in the assessment, we know that according to Finance Act 2024, there were lot of changes made in the section 14B. A new revamped section was introduced from section 158B to 158BI in case of search initiated under section 132 or requisition made under section 132A, which was effective from 1st April 2024. Means for any search or requisition made after 1st April 2024, this new section 158B to 158BI was applicable. Now coming to the further changes made in these sections. Section 158B. Section 158B defines undisclosed income. It will also include virtual digital asset. Now it doesn't mean that virtual digital asset, if it is disclosed in the ITR, will be considered as undisclosed income. If any virtual digital asset income is there and it is not disclosed in the ITR of the person, then it is undisclosed virtual digital asset income. This will be included in the undisclosed income now. This is just a clarification of this definition. Now coming to the next point, 158BA and BA, subsection 2 and subsection 3. It provides for, this is also just a clarificatory nature of amendment. Any assessment or reassessment or recomputation or reference to any order was there. If it is pending on the date of any assessment, reassessment, recomputation, reference or order pertaining to any assessment year, like within the block period of the block assessment, if any of these things are happening and it is pending, then it should be abated, which means any assessment or reassessment, recomputation, these cases, whatever is there, if it is falling within the block period and it is pending on the initiation of the search or making of requisition, it shall be abated. Now similar amendment is required in a case where we know that if any search is initiated or requisition is made and that can be annulled in any appeal, that can be cancelled in any appeal or other legal proceedings. If that is the case, then earlier the reference was given only to assessment or reassessment. Other points like recomputation, reference or any order pertaining to any assessment year was not covered over here. But the intention of law was not that. It wanted to cover everything. So subsection 5 containing the details regarding the annulment of appeal. We'll cover these things also. So it is just a clarificatory nature. Now, the word pending is an issue because if any assessment is there, if a search is supposed to be initiated, if the assessment is not completed in case of that assessee, then how can the department know that search is required? The assessment has to be completed in that manner. So the department has made the amendment in 158 BA subsection 4. The word pending is confusing, so they have changed the word to required to be made, because if search is happening, then assessment would not be pending, it would be required to be made. Either the previous search has been over or the new search is required to be made. It cannot be in the between of the assessment. Coming to section 158 BB, it provides us with the method for computation of total income for block period. Now, total income disclosed was the word earlier used over here. Now we will use the word undisclosed income, and all the income covered under return filed under section 139(1) or under notice under 142 subsection 1 or any notice under 148 is received and we have filed the return. In those cases, all the incomes will be considered. Whatever we have disclosed should be considered and should be allowed credited, should not be treated as undisclosed income over here. It is also proposed that one more amendment will be done while computing the income pertaining to the previous year which has ended, but the due date of furnishing return is not completed. Like, search is initiated on 5th of July in case of individual. The previous year has been completed in March itself, but due date of furnishing of return is still available. So that benefit should be there. On the basis of that, benefit should be there for the individual to get himself taxed as per the books of accounts, whatever is there, because he still have 25 days to file the return. ITR due date is not passed till now, so taxing on the basis of books of accounts is required and he can pay the taxes according to that for the time being. This is the amendment made in this section. Earlier this was not allowed. Earlier when search was there, according to the income tax department, whatever income was there, the tax was paid on that. The calculation was done on that and the tax was paid accordingly. Now coming to the next section, in case of international transactions in respect of search and seizure, 2 points are there. One is the authorizations. Last of the authorizations. Authorizations will start and authorizations will end. It may continue for the period when it may continue for a period of more than 1 year also. So 158 BB says that which relates to any transaction which relates to international transaction or specified domestic transaction from first day of the previous year till the last day of execution of authorizations. Now calculating part period transaction is difficult in this case. So whatever income is earned during this period but the last of the acquisitions is not authorizations is not executed, in that case income pertaining to international transaction or specified domestic transaction would not be included in the income of the block period. Now coming to the time completion for the same case, if any international transaction or specified domestic transaction is happening, then what is the time limit to complete the assessment? Earlier it was 12 months from the end of the month in which the last of the authorizations for search has been executed, but now this time limit has been changed and it has been increased to 12 months from the end of the quarter in which the last of the authorizations or search has been executed. Suppose last of the authorizations have got over in the month of October, so it was taken October 2024, so it was taken as till October 2025, 12 months from the end of 31st October 2024. It was taken till October 2025. Block assessment should be completed. That was the time limit for block assessment. Now it will be 31st December 2025 because the quarter for October will end on 31st December. This amendment will take effect from 1st Feb 2025. Now coming to rationalization of provisions in section 132 and 132B. It is proposed to section 132 of the Act to provide that time limit for taking approval for retention. In case of section 132, in case of search, retention is taken. That time limit for approval of such retention shall be 1 month from the end of the quarter. Earlier it was 30 days from the date of assessment or reassessment or decomputation order. Once the order was passed, assessment order or reassessment or decomputation order was passed, time limit for taking approval for retention was 30 days. Now this time limit has been extended to 1 month from the end of the quarter in which such order has been made. Suppose earlier what used to happen, assessment order has been passed on 22nd of November 2025. In that case, the assessee can apply for retention approval within 30 days from the end of the day, like 22nd November, 22nd December. They will have time till 22nd December. But now what is the case? 1 month from the end of the quarter. So the November quarter is getting ended on 31st December 2025. So they have time limit to apply for retention approval till 31st January, 1 month from the end of the quarter. So till 31st January they have the time. This will be applicable from 1st April 2025. Now coming to section 271AA penalties. Penalties in case of search initiated. If any search is initiated, the existing provision of section 271AA of the Act relates to penalty in respect of searches initiated after December 2016, 15th December 2016. Penalty is applicable. Now, after introduction of block assessment in Finance Act 2024 for searches initiated under 132, this block assessment is applicable in case of searches initiating after 1st September 2024. So, section 271AA is not clear that whether the provisions are applicable. No, it is clear that the provisions are not applicable in the proceedings conducted under 158 BC. So the new block assessment process whatever is there, 271AA won't apply in this case. This penalty won't apply. So now they have made it clear and they have proposed to remove any ambiguous interpretation of its applicability to searches conducted on or after 1st September 2024. This means section 271AA they have clarified that it won't be applied in cases of search which are happening under the new provisions of chapter 14B, that is section 158 BC, on or after 1st 9 2024, because the new assessment proceedings under search is applicable from 1st September 2024. As we said just now, it will be applicable from 1st September 2024. Now coming to section 275, this section talks about the penalties. It says that bar for limitation for imposing penalties. There is a bar for limitation on penalties. Now, it is proposed to amend this section to provide that any order imposing penalty shall not be passed after the expiry of 6 months from the end of the quarter in which the connected proceedings are connected. So, in which the connected proceedings are completed, or the order of appeal is made by the jurisdictional principal commissioner or commissioner. So the amendment in section 275 says that any penalty order shall not be passed after expiry of 6 months from end of quarter in which the proceedings are completed, or order of appeal is received by the principal commissioner or jurisdictional principal commissioner or commissioner. Now coming to the clarification regarding commencement date and end date for the stay period by the court. Under sections 144BA, 153, 153B and two new sections 158BE, 158BFA of the new cases, like basically in the cases of appeals, section 263, 264, these cases, in cases of appeals, wherever time period is mentioned, if any court order or injunction is applied on that case, then that period is not considered in the time limit for completing of assessment or conclusion of the proceedings. In order to remove this difficulty, there was no clarity that till what time it should be there, when it will be said that the proceedings have been completed, when it will be said that the court injunction will be in order till this date. So they have removed the ambiguity and now they have amended the provision that from the starting day of the stay it will start and the end day will be the date on which the certified copy of the order vacating the stay, means the court has vacated the stay. When the court is vacating the stay, then the court will pass an order. The certified copy of the order should be received by the jurisdictional principal commissioner or commissioner. That is the last day of the stay. This amendment will apply from 1st April 2025. So this confusion was there, that from which date this should apply, till which date it should apply. Now that confusion is removed, and it will be up to certified copy receiving by the jurisdictional principal commissioner or commissioner, as the case may be. Now coming to the provisions amended in case of the amalgamation of companies. Earlier, what is the case? Any loss incurred by the amalgamating company will be carried forward to the amalgamated company, whether it is accumulated loss or whatever it might be. Amalgamated company can carry it forward. There was a slag in the act that it will be carried forward up to the 8 assessment years, immediately succeeding the assessment years for which the loss was first computed. Now what was happening, that amalgamated company was saying that they have carried forward the loss. They have computed the loss first time when it was transferred to them. Suppose a loss is there which amalgamating company is accumulating from last 4 years, so they are supposed to carry forward it only up to the period of 4 years. But in the next year, when the amalgamated company into role, they told, we have computed, we are the SSC now, we have computed the tax, we have computed the loss in this year, in the 5th year. So from here we will take the benefit of carry forward of business loss up to 8 years. This problem was there, it was getting continued for a very long period. Now this amendment is done in case of 72A and 72AA, that this loss of 8, it will be allowed to be carried forward for 8 years. Whatever loss amalgamating company is transferring to the amalgamated company will be transferred to amalgamated company. They can carry forward for 8 years itself. But the first year being when it was originally incurred by the predecessor entity. So suppose a business entity is incurring a loss in financial year 23-24, and they are carrying it forward for 3 years, 25, 26 and 27. In the year 27-28, they amalgamated with some other company, or they transferred their business to some other company. Now the other company will say that from 28 we will calculate 8 years till 29, 30, 31, 32, 33, 34, 35, 36. So they did the tax planning in this manner. But now it has changed, that it will be calculated from 23-24 to 8 years, that is till 31-32. This amendment is applicable from 1st April 2026, and it will apply, which means it will apply in case of any amalgamation or any business reorganization taking place from 1st April 2025. Now coming to the next point, Finance Act 2024 said that faceless schemes will be notified for all the cases, appeals or whatever it might be. This was extended to 31st March 25. Now, in few cases, this faceless scheme notification has been omitted, that government is not going to issue the directions in these cases, or it may be issued beyond the cutoff date of 31st March 2025 if it is required. So basically, if we say now, it is not planned for the time being. It is in respect of section 92 CA, 144C, 253 and 255. This will apply from 1st April 25, so they are not going to issue the notification for faceless schemes in these cases. Coming to the case, earlier they have given updated returns option for 2 years. Now it has been increased to 4 years. Earlier we used to pay taxes, additional taxes were supposed to be paid. We know the other conditions of updated return, that we cannot reduce our tax liability, we cannot file a nil return, some tax liability should be there, some payment should be there. If your income is below 2.5 lakhs, then at least 1000 rupees fine has to be paid. So these points we are aware of. And the rates were, additional tax rates were 25% if we are filing the return from up to 12 months from the end of the assessment year, and 50% if we are filing in up to 24 months but after 12 months from the end of the relevant assessment year. Now they have made the changes. 36 months and 48 months, two other criteria have been added over here. You can file the updated return up to 4 years from the end of the relevant assessment year. If you are filing, just to simplify it, if you are filing in the first year, you have to pay 25% additional tax. If you are filing in the second year after the end of assessment year, then you have to pay 50% additional tax. If you are filing, this is the new case now, if you are filing in the third year from the end of the relevant assessment year, then you have to pay 60% additional income tax, and if it is in the fourth year, then you have to pay 70% additional income tax. Suppose you did not file the return for assessment year 23-24. as previous 23-24. The assessment year is ending on 24-25, 31st March 25. Now you can file the return up to 31st March 29. But if you are filing after 31st March 25 but before 31st March 26, you have to pay 25% additional income tax. If you are filing from 31st March 26 to 31st March 27, then you have to pay 50%. If you are filing between 31st March 27 and 31st March 28, then this is a new point and you have to pay 60% additional tax over here. And if you are filing in the last year, which is from 31st March 2028 to 31st March 2029, then you have to pay additional tax of 70% in this case. Now coming to the next point, there is some specified undertaking of Unit Trust of India. What UTI has done, they have created a separate specified undertaking for redemption of schemes, payment of amounts, pending litigation and other cases. It was established by them as per UTI DP Act 2002, and this time period there was a time period that till 31st March 2025 their income was exempted as per section 13(1). This exemption was not provided as per Income Tax Act. It was provided by UTI Repeal Act as per section 13 subsection 1 of the UTI Repeal Act 2002. SUTI, specified undertaking of Unit Trust of India, has been exempted from payment of income tax up to 31st March 23. Earlier this exemption was given till 31st March 23. Now in Finance Act 23, this time period was extended to 31st March 25. But whatever transactions they are doing, redemption of schemes, payments, pending litigation and other things, it may go beyond 31st March 25 also. So they cannot take the exemption. These are the lengthy processes and it may take time. So they have made the exemption, they have provided some more relief to such SUTIs, specified undertakings, and this period is further extended by a period of 2 years. So now if any specified undertaking of Unit Trust of India is having any income, and any income from this redemption of schemes or whatever it might be, then they can claim this exemption up to 31st March 27, and this amendment will be applicable for transactions happening after 1st April 2025.